All right, good morning, everyone, and welcome to another edition of MACROACE with your host, Tony. I'm also the head financial analyst at FinancialJuice. I haven't done a video in a long while, and because there hasn't been anything to note of recent. But with Canadian employment, always an interesting release. The movements can sometimes be sporadic unless the data is very, very strong either way. So what we're going to be doing is we're going to be going through what the Canadian employment change data means, how it will affect the markets, or could affect the markets, and then talk about some of the sentiment surrounding the Canadian employment change, the expectations that other investment banks have for the Canadian employment change data. So let's get into it straight away. So with the Canadian employment change, first of all, what is the figure itself? The headline figure, it measures the change in new jobs being added and includes both full-time and part-time workers. So similar to the US, they will send out a survey to businesses, establishments, and they will collect data on how many people have been, how many people are employed and full-time, part-time, how many job openings do they have, and then collect that data and then provide how many new jobs have been created. Then you have the unemployment rate, which is derived from the what we would call it the household survey, where the government will ask households whether they're employed or not, if they're full-time or part-time, and then the number of hours that they work as well. So those two bits of data, the first one being the one that's watched the most, of course it being the headline figure, and then the unemployment rate, although not as important as the unemployment rate as the employment change figure itself, still quite key to understanding how loose the labor market is, or if there's a tightness, and whether or not then that plays into the central bank's talks later on in the future, whether if the unemployment rate does continue to tick higher, if the central bank has to start pivoting and then go in the other direction. Of course, you can't just look at one release, you have to look at a bunch of releases together. So that's what we want to look at later on too. So first of all, what are the initial effects that the employment data can have on the markets? Same thing with the US employment change data, with the non-farm payrolls data. With the currency, usually a stronger than expected Canadian employment change release will lead to a firming of the Canadian dollar. Of course, there is more confidence that is driven into the Canadian economy, and its future prospects. And also, the other part is that if the central bank sees that the jobs market is heating up, then there is a need to either keep rates tight and where they are and pivot later rather than sooner, or that they might decide to take another interest rate hike instead to try and cement the not only inflationary pressures from getting out of hand, but also the labor market from overheating too much. Then for the bond market, again, if you do get better than expected data, bond yields will usually see an increase in their value because it points to a healthy economy, and usually day traders won't park their money into the bond market unless they feel that there is a risk of the economy heading into a downturn. So instead, they'll keep their money in risky assets such as stocks, and in turn bond yields, their value goes up to try and attract those investors into those bonds to buy government debt and get a yield in return. Stock market, as I just said, so in this scenario with a tightening cycle, it's different being because the central bank hasn't talked about pivoting yet. They've put off the idea that the central bank would talk about or discuss rate cuts anytime soon. But for the stock market at this moment, if you do get higher than expected data or stronger than expected data, then towards the upside, then it can lead to the stock market taking a hit. Referring back to the bond market and how the currency market would react, it would be the opposite. Again, the central bank might decide to raise rates or keep rates for restrictive for longer. And of course, whenever you do that, naturally, borrowing costs will rise and businesses will be able to produce less because debt has become more expensive. and they might have to cut their employment. They might have to cut some of the workforce or be more efficient in how their workforce operates in order to try and combat high interest rates. But on the flip side, if you do have a more anemic or weaker than expected jobs report, that would usually lead to more of a bullish reaction from the stock market instead. And the speculation then grows, and that the central bank doesn't have to remain as restrictive as they have been, and they might pivot sooner rather than later to start cutting rates instead and provide easing to the economy through their monetary policy. So if we look at the previous report, it's a rundown of where jobs were created and where jobs were lost. So in construction, there were about 23k jobs that were added. Information, culture, recreation, about 21k. Wholesale and retail trade, about minus 22k of jobs, less jobs that were created. And manufacturing, that should say minus, but there were 19,000 less jobs in manufacturing that were created compared to the prior month. Then where is the economy at the moment? So the interest rate remaining unchanged at 5%. Inflation at 3.1% compared to 3.8%. Average hourly earnings also ticked lower as well to 5% compared to 5.3%. GDP quarter-on-quarter annualized was also weaker than what was expected and compared to the prior figure at minus 1.1%. The month-on-month, more or less flat at 0.1%. Employment change last time round, you can see that the Canadian employment change data jumps around a lot. You don't really get a solid increase in the amount of jobs that are created or solid decrease. It can make the job of the central bankers a bit harder to kind of pinpoint, looking at monthly figures month by month. Hence, they look at the data overall, and then they decide whether or not the labor market is either tight or loose. The unemployment rate ticked high to 5.7%, and manufacturing PMI data was at 48.6 compared to 47.5. Then the triggers for the economic release. So according to economists, what they've given as their high and low estimates, they see a high estimate of 52k, so that's about a 38k or let's say 40k deviation, with a low estimate of minus 5k, with about a 19k deviation. At the unemployment rate, they see a high estimate of 5.9% and a low of 5.7%. And then the average hourly earnings, they see a high estimate of 5% and a low estimate of 4.7%. So this is quite interesting, considering in the past where we've had, and if you've seen the deviations sheet before, or the deviations and ranges, you would have seen that the last time around where it was paired with US data, last time around that we did have Canadian data by itself, the market reaction wasn't very strong in majority of the currency pairs compared to what we've seen in the past. Like we've had in the past where we had about a 43k, about 44k deviation on the headline figure. The biggest market reaction was seen in the currency pair of GBP CAD. And consistently, GBP CAD has seen the biggest market reaction. But that doesn't mean that you can't just put off the release altogether and that it doesn't present an opportunity or potential opportunity. And then sentiment and views, you had Bank of Canada meeting minutes. I said ahead of the Bank of Canada rate announcement, some members of the Governing Council felt that the rate would more than likely not need to increase further. And Senior Deputy Governor Rogers said the Bank of Canada is not yet talking about reducing rates. So you could continue seeing, if you do continue seeing strong jobs data from Canada, that might just reinforce the point that Deputy Governor Rogers has made there, that it will extend the time that the central bank will start talking about pivoting and cutting rates instead. Although the inflation goal is more or less there with the Bank of Canada, where they've reached, on the flip side, you also have the jobs market data too, which is also quite important for the central bank in achieving a stable condition within the economy so that it doesn't overheat, where the central bank will have to jump in again to raise rates. So still quite an important release to be aware of. Investment bank views, you had CIBC, they forecast 10K, Scotiabank 15K, BMO about 20K, and Bank of America about 13K. So I'm just going to grab the video of the previous market reaction. We've got about 5 minutes left, but I feel that it's still important to kind of like, actually we'll have a look at the deviations because that will give a good overview. So let's get out of this here. Bring this up. So if you're not familiar with what the deviations and ranges Google Sheet is all about, this shows you how the markets have reacted in the past to previous economic releases, depending on what the figures were like. And we have different figures here. So we have, so hopefully you can see what I highlight. You should be able to. So this figure here, this initial figure, shows you the initial market reaction on the first candle on a 1 minute chart, going to the wick of the candle to encapsulate the entire move of or the how big the initial move was. And then the figure in brackets here shows you how big the movement was 10 minutes after the release had come out, going to the end of the candle. And then here in the blue brackets, the blue you might be able to see clearly, but that shows you the market reaction 30 minutes after the economic release has come out. And as you're looking at this here, you can see generally that GBP/CAD has seen the biggest market reaction out of the other currency pairs. Even with the Japanese yen, when there was a lot of weakness and continuation of easing from the Bank of Japan, you've seen here GBP/CAD has seen the biggest market reaction overall. So that's what we're going to be looking at. But alongside that, we've got the EUR/CAD that's seen a decent market reaction. When even here, you might have seen a small amount of deviation. But remember, some of these releases were paired with the US. So if there was good US data or bad, if there was good or bad US data, then the market reaction for Canada would be bigger because it's a dollar-based, a dollar-denominated currency. Now, of course, against the dollar itself, it will have a different reaction depending on how good or bad the US data is. But against other currencies, it will more or less mimic, to a degree, what the US dollar does most of the time. Not all the time, but from what we've seen in the past. So we've got about 2 minutes left, and as said, you can see here that the deviation wasn't that much, but it was paired with the US data. So now that the Canadian data is by itself, it gives you a more of a focus on the Canadian dollar rather than having to focus on US data and looking at the dollar itself with the Canadian dollar. So it is not as important, but still important for the Canadian dollar, and has had some nice reactions in the past. So let's close this away. Let's get ourselves set up on TICKSTRIKE. So here we go. We're looking GBP/CAD here. We've got EUR/CAD, NZD/CAD, CAD Swiss franc. So those are the ones we're going to be looking at mainly. Where are we? Okay. It's EUR/CAD. GBP/CAD. Let's get that out of the way. Okay. Perfect. All right. 1 minute to go now. Well, less than a minute. Let's see. Well, about 30 seconds left. 10 seconds. Okay, that's 24.9k. 24.9k, higher than the forecast of 14k. So that's so it's about 10.9k deviation. So not as big as the deviation as what economists were expecting. Did see a bit of a pop towards the upside on the Canadian dollar, so a bit of strength there. Let's do some market measurements and see what we get, see what we have. Also, the unemployment rate ticking, so unemployment rate at 5.8% unchanged or as expected. Then you have the Canadian average hourly earnings did tick up slightly to 5%. But again, not a crazy amount of deviation, not really a lot of deviation there. But you did see that initial pop from the Canadian dollar off the back of that data. And also, just looking at the market reaction so far, we're looking at GP CAD, which had the largest market reaction last time round. This dwarfs it. So this doesn't dwarf it. This is much smaller than what we had seen last time round. I think it was about 40 pips. So let me just bring that up again. What the initial market reaction was. So yeah, so last time around there was about 40. It was about a 40 pip move towards the upside on GP CAD on weaker than expected Canadian data. Bear in mind that was also paired with the US data last time around too, and non-farm payrolls back then didn't see. It's seen weakness from the dollar, so that helped to add to some of the momentum back then. But now it being by itself, and the deviation wasn't that much, it's not really seeing that much movement. So yeah, so GP CAD, the biggest market reaction last time, when it had experienced a big market reaction, a bigger market reaction last time of about 38.2 pips towards the upside. This time around on the initial market reaction, just getting about 19.5 pips towards the downside here. If we look at EuroCAD, because I did have the second largest reaction last time. It's not really doing too much. It's about, yeah, so 16, again, about 16.5. Yeah, well, 17 pips down. Okay, let's go insert DCAD. Okay, it's about 8 pips down. Yeah, so very muted market reaction to this data here. So yeah, as I was saying, with the Canadian, with the deviations and ranges and deviations Google Sheet. So this is completely free for users to access, those who are subscribed to the MACROACE mailing list. And again, as said, it goes through, it breaks down how big was the market reaction in the initial market reaction, 10 minutes afterwards, and then 30 minutes afterwards as well. So that's what the deviations sheet is all about. So you can see that there. There isn't just the Canadian employment change data. There are other bits of data too. So US CPI, PPI, which still has some decent reaction here and there. You got non-farm payrolls, which we'll have next week with non-farm, because of course we didn't have it this week. And then other releases. Some of the releases might not be there because either that the market reaction hasn't been as big as it used to be, or the importance has kind of faded away in favor of other releases that the markets might be focusing on instead. But in order to get your hands on this, all you have to do is subscribe to the MACROACE main list, which is here. Let me just pop that into the chat there for you. Okay, and that is there for you. And also don't forget, if you like the video so far, then don't forget to give it a like, subscribe to the channel, get the word out there, spread it to your fellow traders and friends if you found the information useful to your trading day. So then that leads me on to talking about FinancialJuice. So FinancialJuice is a live voice and text service with our news feed, and you have your, so here you have your live voice feed here, okay, keeping you up to date of the global news that could be impacting the markets and sentiment overall. And that's all in one place. So we provide that via voice and text here on our news feed that you can see there with real-time headlines. And on the left-hand side here, you have the economic calendar with all the bits of data as well, all there, all on one side. So you can keep up to date with what's going to happen for the week ahead. Again, all in one place. So it's fair. So also, we currently have an offer, if you haven't seen it already, that you can get FinancialJuice Pro for a year's worth of our service for the price of 1 month, or for the price of our monthly service instead. So it's $99 per month that you usually pay for if you were to do it via the monthly, but for a year's worth of a service, you can get that again at the same price for a year's worth instead at $99. But yeah, so that is FinancialJuice there. So I think that's going to be ending next week, that offer, with the offer of getting FinancialJuice Pro for a year at $99 for the year. But yeah, so do have a little look. Now, if you haven't signed up to FinancialJuice, or if you're looking to go pro, then make sure what you do is you create an account on FinancialJuice. You'll be set up with the light version initially, and then go to your email, verify your account from your email, and then when you're ready to, and then go back to your email, go back to the newsfeed, and if you are ready to go pro with FinancialJuice, there'll be a button in the top left-hand corner, kind of where this slider is. It's near there, basically. It will say Go Pro. Select that. Select your subscription that you want to select, and use. Once you've paid for your subscription, then log out and then log back in, and then that should give you the pro version of the feed that you can see here on the live stream. Okay. So yeah, that's FinancialJuice Pro, and then TICKSTRIKE. So if you haven't come across TICKSTRIKE before, if you're unsure of what it is, giving you a live demonstration here right now with it. So TICKSTRIKE allows you to listen into order flow and shows you how strong the buying or selling is within a particular asset that you may be looking at. Okay, so if we pull up this bit here with GBP CAD, so this ticker box here, what it shows you have a slider here which goes from 1 to 15. This is the level of sensitivity for that ticker box. So level 1 is the most sensitive to market reactions. So when there's a little bit of, as you can see here, buying or selling that occurs, then TICKSTRIKE will give you that visual and audio alert. Okay, or you can choose to go either visual or audio, whichever one you want to go with, but it gives you a visual and audio alert. So if I were to increase this level all the way to 15, of course you can kind of chop and change wherever it is. Level 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling that occurs will TICKSTRIKE give you an alert. So if, as you can see here, I've put it to 15. And you can see the other markets are seeing these little bits of buying or selling that's going on and are reacting there. But here it's not reacting so much. Okay. So as I said, you can kind of chop and change and play around with it. Another cool feature of TICKSTRIKE, which is quite new, is the lightning bolt ticker. Is the lightning bolt bit here. So this basically makes TICKSTRIKE uber sensitive to market reactions. So when there's a lot of buying or selling momentum, that is when there is a little bit of buying selling momentum that's occurring, as you can see there, TICKSTRIKE will give you an alert to that asset visually and audibly as well. Okay, so that's the lightning bolt version, and again, you can kind of chop and change how sensitive you want that to be. So remember, the lightning bolt version is 15 levels below 1. So when there's, so you can see here, it's just going crazy. It's a bit too crazy for me, but if you're scalping the markets, then it's the perfect tool to add to your repertoire, to then use however we want to use it. And for me, as I said, it's a bit crazy, but but as I said, that's the tool there. So this tool is made for the day traders, using TICKSTRIKE, capitalizing all those potential opportunities, managing your risk where there might be. And then, as said, if you're not used to using TICKSTRIKE, if you've never come across it, then on the feed here we have our limited version of TICKSTRIKE. We can look at the S&P 500, Euro, Dollar, Oil, and Bitcoin. Is limited to the sensitivity as well, so you can't chop and change it. But just so you get in the hang of it, and then when you are ready to have a little play with it, we also have the 7-day free trial of TICKSTRIKE to have a little play with. And then that's a trial of the full version of TICKSTRIKE that I'd shown you guys there. Okay. All right. So that's the link for TICKSTRIKE, and yeah, that's basically summarizes it. So this is what I've currently got at the moment on my trade on CAD JPY that I've had here. So of course, didn't get to jump in on the initial trade there, but you can see where I've jumped in. But yeah, so all right, ladies and gents, thank you very much for joining me live. Now, for those of you who sign up to the MACROACE mailing list, you not only do get access to the deviations on the Google Sheet and the ranges for the week ahead, but you also get access to, but what you also get is an email from myself giving you a rundown of what to expect for the week ahead in Europe, Asia, and the US. It's a very short summary. There's not a lot of information that is provided. It's more of a refresher is how you should take it. But as said, so that's what the mailing or the email that you would get every Monday morning. You'd get that email there from myself. But yeah, that concludes the stream. Thank you very much for joining me live. Don't forget, as said, to like the video, subscribe to the channel, get the word out there, and I will see you guys later.